Hello everyone, welcome to today's lecture video covering Chapter 3, which discusses how securities are traded. So first we'll begin with a chapter overview. In this chapter, I will provide a broad introduction to the many venues, so the many locations and procedures available for trading securities, both stocks and bonds, but primarily stocks, in the United States and international markets. So we will be discussing trading securities, so the types of markets, the different types of orders, etc. We will be discussing the mechanics of trade execution, and we will also be discussing the essentials of some specific types of transactions, including buying on margin and short selling. So as we work through this lecture video, I will provide a few areas where it might be wise to take a break as we will be transitioning from one main concept of the chapter onto the next. So if you're feeling a little overwhelmed by the amount of material that is being discussed, I will provide some areas in which a break might be necessary. So let's jump into Chapter 3's discussion. So the first thing that we will discuss is how firms issue securities. So firms issuing new capital can raise these funds by borrowing debt or borrowing money, so the form of debt, or selling shares, so equity in the firm. And these are done in two different types of market transactions. The first is a primary market transaction. The primary market is the market in which new securities or new issues of securities are offered to the public, so that's the key part there. This is where the issuing firm actually receives the proceeds of these offerings. Typically, these primary market transactions have investment bankers, usually being hired to manage the sale of these securities in the primary market, and we'll discuss how all this happens here in the upcoming slides. Then the other type of market transaction is a secondary market transaction, which involves the already existing securities being bought and sold on the exchanges or in the over-the-counter market. Shares of publicly listed firms. So these publicly listed firms can also go by the names of publicly traded or public companies. These shares trade continually in markets such as the New York Stock Exchange or NASDAQ, but the shares of private corporations are held by small numbers of managers and investors. So the first thing that we will be discussing is how do these privately held firms issue their securities. So as I mentioned, we are focusing here on privately held firms. Well, what are privately held firms? Privately held firms are owned by a relatively small number of shareholders. They have fewer obligations to release information to the public, so this would save money for these firms by not having to file these different reports. It also could possibly provide more flexibility for these companies, in particular focusing on long-term growth, but they do have fewer obligations to release information to the public. In 2012, there was a Jumpstart Our Business Startup Act put into effect, and what this did was it actually increased the amount of shareholders that these privately held firms could have up to 2,000 shareholders. It was up to 499 shareholders, and these privately held firms raise funds through private placement. And just real quickly before we go into this private placement discussion, this was key in 2012, the Jumpstart Our Business Startups Act, allowing you to look at investors all the way from 499 to quadruple that up to 2,000 shareholders provides much more access to capital for these privately held firms. Now, how do these firms raise their funds? They raise funds through private placement. The definition of private placement is primary offerings in which shares are sold directly to a small group of institutional or wealthy investors. So they are issued directly to these different investors. You don't need to prepare registration statements like you would if you were a publicly traded company. But there are, with these private placements, you do have limited offering size. So as you can see, we only can go up to 2,000 shareholders. And as a result of them not being traded on an exchange like a publicly traded company would be, there is decreased liquidity for the shareholders within these privately held firms. So those are our privately held firms and how they issue new securities. Now let's move on to publicly traded companies. So with publicly traded companies, what they have is an initial public offering or an IPO, and this is a firm's first issue of shares to the public. So this is when a private company or a smaller company is choosing to raise capital, I shouldn't say smaller, where a company that is not yet publicly listed is choosing to raise capital from a wide range of investors. So what they choose to do is they choose to go public so that they can target the large public market. Now, this initial public offering is the firm's first issue of shares to the public. So this is the first time that investors have an opportunity to be shareholders on this firm that is now choosing to go public. Now, there is another thing called a seasoned equity offering. So the seasoned equity offering is the sale of additional shares in firms that are already publicly traded. So this is, for example, a company like Apple, already publicly traded, already traded on these different secondary markets or on these financial markets, and this would be them deciding to issue new or additional shares of equity. So this is what is called a seasoned equity offering. Now, these public offerings of both stocks and bonds typically are marketed by underwriters. So underwriters are typically investment banks, such as Morgan Stanley or Goldman Sachs. And what these underwriters do is they often purchase the securities from the issuing company and then resell them to the public. This is what is called a firm commitment underwriting. So firm commitment being that they are bearing the risk of selling the shares. They are buying the shares and then reselling them to the public. There are other methods in which these underwriters perform or these underwriters act. But the one that I wanted to focus on or discuss or at least mention is a firm commitment underwriting where they purchase the shares and then reissue to the public. And these underwriters, these investment banks, advise the firm regarding the terms on which it should attempt to sell the securities. So you're talking about the price and the amount and who to distribute them to. These are different things that the underwriters, typically investment banks, will provide, the different information that they will provide these companies wishing to go public. So let's just take a look at the relationship among a firm issuing the securities, the underwriters, these investment banks, and the public. So you have your issuing firm, the company looking to go into an IPO or a seasoned equity offering, more focused here on the IPO side of things. You have your lead underwriter, which would be your lead investment bank. They gather and have other investment banks that operate as an underwriting syndicate. So these are just simply other investment banks who will share in that responsibility for the stock issue, and then these underwriting syndicate banks will then distribute or resell the offerings to private investors. Another aspect of these IPOs and this offering of the new equity securities is a term called shelf registration. So shelf registration, this Rule 415 was introduced in 1982, and it allows firms to register securities and then gradually sell them to the public for 3 years following the initial registration. So they register their securities initially, and then they can distribute these securities over a 3-year time period with little additional paperwork. And as a result, these shares can be sold on short notice and in small amounts without incurring high flotation costs. Now, these issues that are not yet distributed are referred to as on the shelf. So they have already been approved, they have just not yet been distributed. Continuing with IPOs and a little bit more discussion on how the IPO process works. So first, these companies that are looking to have an initial public offering will start with their preliminary registration statements being filed with the SEC. This is a requirement. We'll discuss why it's a requirement here towards the conclusion of today's discussion. But they first start with their preliminary registration statements. Then what happens is the investment banks hold what is called a roadshow. And this roadshow is going around the country to publicize the new offering and build the books. So book building is what determines the demand, and it looks at the degree of investor interest, providing valuable pricing information. So the price that they should issue this new offering to, how much, where should it be allocated. Not how much, but how much could be priced, but I was more so focusing on the size, the actual amount of shares that they should issue. And then the shares of the IPOs, once the IPO is conducted, are then allocated across the investors in part based on the strength of each investor's expressed interest. So it is important that these, during the book building process, that when they're looking at potential investors, that these potential investors do provide realistic insight as to the amount that they would like to purchase and also the amount that they are willing to pay. So a couple things to consider with this IPO process is that typically the underwriters, these investment banks, will charge a 7% fee of the funds raised. So that is a cost of these IPOs. And then with these IPOs, there's also oftentimes what is called IPO underpricing. So what happens with the IPOs is that the price often jumps on the first day of trading, and the companies actually that are having the IPO are then losing out on the funds that they could possibly have raised if their IPO price was actually higher. So continuing with the IPO process. These underwriters bear what is called price risk. So I talked about the firm commitment underwriting, where they are purchasing the shares from the company having the IPO and then redistributing or selling them out on the market to investors. So if the underwriters are left with unmarketable securities, they have to sell at a loss on the secondary market. This is what price risk is for these underwriters. So as a result, IPOs are commonly underpriced compared to the price they could be marketed. An example would be Google. So Google went public on August 19, 2004 on NASDAQ with an IPO price of $85 per share. Their return in one day was actually 18%, and then for the course of the year, it actually was a 229% return on that particular investment. So they had an IPO of $85, but based on the demand of investors, that was actually underpriced, and they could have had a higher IPO price since the price of the stock jumped 18% in that first day. And then investors actually viewed Google very strongly, and you could tell that that stock price was highly valued as a result of that 229% increase that first year. Now, that's an example where IPOs are underpriced. Some IPOs are actually overpriced. An example would be Facebook. So Facebook went public on May 18th, 2012 on NASDAQ, and their IPO price was $38 per share. In day one, their return was 0.6%, and then for the first year, it was actually a negative 31%. So it was actually overpriced on this initial public offering. Now, since this initial offering in 2012, the stock price has gone up considerably, but at the initial offering and for that first year, the prospects of this company were actually much lower than the initial IPO price. So those are two examples where the IPO was overpriced, and then one where it was underpriced, and then one where it was overpriced. And then as a result, some of these IPOs cannot be fully sold, and that goes back to this price risk that the underwriters bear. So if they cannot be fully sold, the underwriters, if they have purchased those shares from the issuing company, then they are going to be selling these shares at a loss on the secondary market. So just to provide a little context on how often or how these IPOs typically work and how they are typically underpriced in comparison to what the firms could actually raise if they priced the IPOs a little bit higher. You can look at the charts here of the average first-day returns on mostly European IPOs and then non-European IPOs, and you can see that the average first-day returns are pretty strong. So you can look at these different countries and what their typical average first-day returns are, but this is really just a showcase that oftentimes IPOs are underpriced from what they could actually earn. So it's thought that these companies that are initially offering these securities are actually missing out on funds that they could have raised if they had a higher IPO price. There is some research about IPOs not being, even though these charts showcase strong one-day or first-day returns, there is research on the arguments of long-term success, but this is just showcasing this underpricing theory of the initial offerings being underpriced from what they could earn otherwise. And when I say earn, that's from the issuing firm's perspective in terms of the capital that they could raise. So next up, we're going to discuss types of markets. So there are 4 types of markets in which these securities are traded. The first is a direct search market. This is your least organized of the 4 markets that we will discuss. And this is where buyers and sellers seek each other out directly. So this involves sporadic participation, typically non-standard goods. Some examples of a direct search market would be you posting a classified ad to sell something. So posting a classified ad in a newspaper or posting an item on Craigslist would be an example of a direct search market. Next type of market is a brokered market. So this is where brokers offer search services to buyers and sellers for a fee. You can think of the real estate market. You can also think of primary security markets as being brokered markets. Then we have dealer markets. Dealer markets have traders that are specializing in particular assets, buying and selling the assets for their own accounts. Easy example of a dealer market would be an auto dealer. Other dealer markets that we'll talk more about today are NASDAQ and the bond market. And then the fourth type of market is an auction market. So all traders in an asset meet either physically or electronically. It's called a centralized market, since you're meeting at a centralized place, and they sell at this one or they meet at this one place to buy and sell. So there's no need to search across dealers to find the best price. Buyers and sellers meet either physically or electronically to conduct the transactions. So the best example for an auction market would be the New York Stock Exchange. So just a recap: NASDAQ would be your dealer market, the New York Stock Exchange will be your auction market. And the reason why I focus on those two here is that I provide more specifics here later on. So before we get into some different types of orders on these different markets, just a quick refresher on market orders. We've talked about this in previous chapters, but first would be your bid price. Remember, bids are your offers to buy. In dealer markets, the bid price is the price at which the dealer is willing to buy. And then the investors sell to the bid, so that's what they would be selling to the dealers. That's the price that they would receive. With the ask prices are sell offers. In these dealer markets, the ask price is the price at which the dealer is willing to sell, and the investors must pay the ask price to buy the security. Keep in mind that the bid-ask spread is the difference between a dealer's bid price and the ask price, and that's how they make their income. The dealers make their income on this difference here between what they are willing to buy it at and what they're willing to sell it at. So continuing on now with types of orders, the first type of order is what is called a market order. A market order is an order that is to be executed immediately. So execute immediately at whatever the current market price is. So your bid and your ask prices. The main issue is that your execution price is not guaranteed, meaning that let's say the bid price, let's say the ask price is $1.15 times 100. That means that they are willing to sell 100 shares at $1.15, but let's say you want 200 shares. So you would have to go down to the next ask price in order, you'd have to go down to the next ask price, which will probably be a little bit higher to fulfill your total sale. And then share prices are fluctuating at rapid pace, at rapid speeds, so your execution price is not 100% guaranteed. The second type of order, so that is a market order, so execute immediately. The next two types of orders are limit orders and stop orders. This group of types of orders are called price contingent orders. And as I mentioned, there's two types. The first is a limit order. With a limit order, it's an order specifying a price at which an investor is willing to buy or sell a security. And you have two different types. You have a limit buy, which says you buy at or below a certain price, and a limit sell, which says you sell at or above a certain price. And then we also have stop orders. Stop orders is when a trade is not to be executed unless the stock hits a price limit. The most common type of stop order is what is called a stop loss order, and that tells the broker to sell if the price falls below a particular number to stop your losses. But there are also stop buy orders where you buy if the price rises above a limit. So just to take a look at the types of orders that we just mentioned, in particular the price contingent orders is what we're focusing on here, and what would happen on different conditions relative to what your action would be. As you can see here on the left-hand column, if the price falls below the limit, then you would buy using a limit buy order, and you would sell if it falls below. If you were wanting to sell it, you would use a stop loss order, and then vice versa. If the price rises above the limit and you're wanting to buy, you would place a stop buy order, and if you're wanting to sell, you would place a limit sell order. So let's do an example. So what type of trading order would you use? I'll give you about 5 seconds after I present the order or present the scenario. You might want to pause and check your understanding and see if you get the same answers as what I discussed. So the first one is you want to buy shares of Facebook. You believe the share price is approximately at the fair value and you want the trade done quickly and cheaply. What type of order will you put in? Give you a couple seconds here. So the type of order you would put in would be a market order buy. So a market order just simply stating that you will take whatever the current price is at that time, since you do believe the price to be accurate at this point. Next up, you want to buy shares of Facebook, but you believe that the current stock price is too high given the firm's prospects. If the shares could be obtained at a price 5% lower than the current value, you would like to purchase shares. What type of order will you put in? You think it's too high currently. If it's lower, you would end up purchasing it. You would end up putting in a limit buy order where you would buy it as soon as that price dropped below some particular level. Third example, you plan to purchase a condominium sometime in the next month or so and will sell your shares of Intel to provide the funds for your down payment. While you believe that Intel share price is going to rise over the next few weeks, if you are wrong and the share price drops suddenly, you will not be able to afford the purchase. Therefore, you want to hold on to the shares for as long as possible, but still protect yourself against the risk of a big loss. What type of order would you put in? Okay, you want to stop your losses, so this is simply a stop-loss order. So a stop-loss order meaning that you would sell your securities once they hit that lower price that you cannot go below. So as I mentioned, there are some break points here before we move on to a different concept area of the chapter. So if you're needing a break to kind of process what we've covered so far, now would be a good time to take that break, and when we come back, we'll talk about the different trading mechanisms. Okay, so now on to trading mechanisms or trading systems. So an investor who wishes to buy or sell shares, they're going to place an order with a brokerage firm. Now, these brokers have several avenues by which they can execute that trade. The first trading mechanism or the first trading system is through what is called a dealer market. So with dealer markets, you have what is called the over-the-counter market. The over-the-counter market is an informal network of brokers and dealers where securities can be traded. It is not a formal exchange of itself. Examples would be NASDAQ. NASDAQ is actually a formal exchange, but it has over-the-counter market transactions, and we'll discuss NASDAQ in more detail here shortly. And then we also have the bond market being an over-the-counter market. We're going to discuss all of these in more detail here on the following slides. The next type of trading mechanism is the ECN market, or the electronic communication networks. These are computer-operated trading networks, so these are computer networks that allow direct trading without the need for market makers. So basically what they do is they facilitate trading across markets. They offer cheap and fast trading as well as anonymity. The share of electronic trading of using these ECNs is actually increased to over 80%, and these ECNs are now dominating the trading in most stock markets. So we'll talk in a lot more detail about ECNs on the following slides, but with these ECNs, an individual investor must hire a broker who is a participant on the electronic communication network, and then that broker then would execute the trade on the investor's behalf. So the key with these electronic communication networks, I'm not really sure why this is bolded in comparison to the other ones. I should have bolded this one as well, and ECNs and the next one. But anyway, this is just a second type of trading system in which you have computer-operated, computer-linked networks where you don't need to have market makers helping with the trades. The last type of trading mechanism is a specialist or a designated market maker market. So these designated market makers used to be called specialists, and what they do is they accept the obligation to commit its own capital to provide quotes and help maintain a fair and orderly market. So effectively, this is just an auction market with a centralized order flow. And so whenever the liquidity is poor for a particular security, so there's people wishing to sell their securities, but there's difficult finding a buyer, what would happen is that these specialists would step in as a dealer. An example of a designated market maker trading system is the New York Stock Exchange. And so once again, I talked about NASDAQ being up here in a over-the-counter type of market, and then the New York Stock Exchange being this designated market maker type market. So the first thing that we'll go into is discussing NASDAQ. What is NASDAQ? Well, NASDAQ stands for the National Association of Security Dealers Automated Quotation System. And what it is that it is a computer-linked price quotation and trade execution system. That's where you get the automated quotation system, is it's quoting its prices. So it is the largest stock market for over-the-counter trading. It originally was more of a price quotation market or a price quotation system, and it was the first stock market to trade online. Now, with NASDAQ, it lists about 3,000 firms. Typically, it has smaller firms in terms of market capitalization. The NASDAQ's Market Center, which is its electronic communication network, so its Market Center is its ECN. It consolidates NASDAQ's previous electronic markets into one integrated system that now handles the majority of its trades. And there are 3 levels of subscribers. You have level 1, you have level 2, and you have level 3. And the difference between the levels is based on how much information you have. So with level 1, that's your lowest level of subscribers. With level 1 subscribers, you only receive your inside quotes. So you receive the best bid and ask prices with level 1 information. With level 2 subscribers, you receive all your bid ask quotes. But you can't enter your own quotes. And then level 3 subscribers are the registered market makers of NASDAQ. So they are the ones that actually enter the bid and ask spreads or the bid and ask quotes on these different securities. So that would be an over-the-counter type of system. The next type of system, if you remember again, is electronic communication networks. Again, these are computer-operated trading networks for trading securities. Some of these ECNs are registered as formal stock exchanges, while others are considered part of the over-the-counter market, and they compete in terms of the speed they can offer. And that a term that we should introduce is the term of latency. So latency refers to the time it takes to accept, process, and deliver a trading order. It used to be that it would take seconds to process this new order. Now with everything being linked electronically, it happens almost simultaneously. So for example, the CBOE Global Markets, which owns BATS, which is a electronic communication network, it advertises an average latency time of around 100 microseconds. So it can accept, process, and deliver an order in around 100 microseconds. Think of how fast that is. So let's go into a little bit of a discussion into the rise of ECNs. So in 1975, first there was an elimination of fixed commissions on the New York Stock Exchange. So basically what this did was it allowed brokers to now compete on lower fees or lower commissions. So instead of having fixed commissions, these brokers could actually list what they were willing to charge in terms of identifying or executing these trades. Then in 1994, the new order handling rules on NASDAQ led to narrower bid-ask spreads. And then in 1997, the reduction of the minimum tick size from 1/8 to 1/16 of a dollar. So a tick size is simply the change between a bid and an ask price. And so they reduced it from 1/8 of a dollar down to 1/16 of a dollar. So there's much smaller spreads between the bid price and the ask price on these securities. Then in 2000s, in the U.S., the share of electronic trading rose from 16% to 80%. So as I said, 80% of transactions are now done using these electronic communication networks. In 2000, we had the emergence of the NASDAQ stock market, which was effectively a large electronic communication network. In 2001, this decimalization allowed the tick size to fall down to 1 cent, so it went from 1/16 of a dollar or an eighth of a dollar to a 1/16 to a dollar, all the way down to a cent. In 2005, the SEC adopted regulation NMS, so for National Market System, and the goal of this adoption by the SEC was to link the exchanges electronically. In 2006, the New York Stock Exchange acquired Electronic Archipelago Exchange and renamed it New York Stock Exchange ARCA. So this is what their ECN is. So this is the ECN of the New York Stock Exchange. And then in 2007, this national market system was fully implemented. And why is this important? Well, looking at the rise of electronic trading and having all of these markets connected electronically and then decreasing the tick size between the bid price and the ask price, notice what's happened to the effective spread. So that's your difference between the bid price and the ask price, and how it's changed dramatically as the minimum tick sizes actually fell. So you can see it's almost up here it's cut in about a quarter here, measured in dollars per share, as the tick size went from an eighth difference down to a 16th, down to decimal, down to a cent. So this is less dealer profit on these different transactions. Continuing on with our third type of trading system, it was the designated market makers, focusing now on the New York Stock Exchange. So the New York Stock Exchange is the largest U.S. Stock exchange as measured by the market value of the listed stocks. Its automatic electronic trading runs side by side with its broker specialist system, so it runs side by side with its designated market maker system. Now, these brokers or specialists need to purchase the right to trade. It used to be you would purchase a seat. Now you purchase a license. And to be listed on the New York Stock Exchange, there are very high or strict listing requirements. So looking at their transition to electronic trading in 1976 and later, they used dot and super dot. Then in 2000, they used direct plus, and in 2006, you had the New York Stock Exchange hybrid. What this has done is it allowed the New York Stock Exchange to qualify as a fast market for the purposes of that regulation, NMS, which we said was put into a full effect or fully implemented in 2007, but it still offered the advantages of human interaction for complex trades. So that's something that it prides itself on. Was this human interaction, but it allowed this New York Stock Exchange hybrid, allowed it to still qualify as the fast market for the purposes of regulation NMS. So next is new trading strategies. So those are different markets in which, or those are different trading systems in which trades occur. Let's discuss a few new trading strategies that have come about in more recent years. The first is algorithmic trading. This is the use of computer programs to make trading decisions, and a subset of algorithmic trading is high-frequency trading. This relies on computer programs to make extremely rapid decisions. So some strategies may be exploring the trends in bid-ask spreads, and this high-frequency trading actually is believed to account for more than half of equity trading in the United States. So computers can make decisions much more quickly than the human can actually process new information and changes in information. And so this algorithmic trading and high-frequency trading is something that has grown substantially over the previous years. Additionally, there are things called dark pools. Dark pools are private trading systems in which participants can buy or sell large blocks of securities without showing their hand. A large block defined is at least 10,000 shares of stock being bought or sold. So these will help not substantially influence the markets by trading in these dark pools, but these are private trading systems in which the large sales are not exposed to the public. Continuing, we have they're exposed to the public without showing the exact transaction details. Last up with new trading strategies deals with bond trading. So with bond trading, this is considered a new trading strategy here in this particular area, because until 2006, each bond that was traded on the New York Stock Exchange had to be registered individually. Now, since 2006, the New York Stock Exchange can include the debt issues of any New York Stock Exchange listed firm. So the bonds did not have to individually register to be traded on the New York Stock Exchange. Now, the vast majority of bond trading takes place in the over-the-counter market among bond dealers. And the market for many bond issues is thin and subject to liquidity risk. So liquidity risk would just simply be the ease of taking that asset and converting it to cash quickly without a substantial loss in value. And they say this is thin because there may be few investors that are looking into trading, so buying or selling a very specific type of bond. So the market for bond issues is what is considered thin. And one impediment to heavy electronic trading is the lack of standardization in the bond market. I apologize. So a single company may have dozens of outstanding bond issues differing by coupon, maturity, and seniority. There's no real standardization in the bond market. Moving on to the globalization of stock markets, and then we'll take another little break. So in recent years, there has been pressure to make international alliances or mergers. So most of this pressure is due to the impact of electronic trading. So linking these different exchanges, there's been a wave of mergers that have led to a few giant security exchanges such as ICE, NASDAQ, the LSE, and others. So just looking at some details of these mergers and alliances that have occurred recently. First of all, the New York Stock Exchange, you can see all the different details that have occurred over that 6-year period in terms of its mergers and acquisitions. Then with NASDAQ, I'm not really focused on the individual mergers and acquisitions that have occurred, more so understanding that the markets are now globalized due to primarily changes in electronic trading, and this is just showcasing what's kind of occurred over the past 15 years or so. Additionally, we can look at Euronext and its acquisitions and mergers, and then we can also look at the Chicago Mercantile Exchange and its different acquisitions. So globalization and consolidation of security markets takeaways. First of all major stock markets today are effectively electronic, which creates international alliances and mergers. Traders view stock markets as a network that link them to other traders, and you can benefit from economies of scale with these alliances and mergers, and companies want to go beyond their national borders when they raise capital because that will give them much more access to funds. So looking at the biggest stock markets in the world, once again, it just provides some context here. You can see that we have New York Stock Exchange and NASDAQ as our top two. Looking at this is in $1 trillion of market cap, so I should have this. So this is by market cap, and this is a 2018 figure. So that's not a very good labeling on my part here. But these are the biggest stock markets in the world by market cap in 2018, just to provide a little bit of context here. And one last thing then, dealing with these different types of trading, let's look at trading costs. First of all, we have explicit costs, and these are your brokerage commissions. So we have two different types of brokers. You have full service versus discount brokers. With full service brokers, what they do is they make specific buy and sell recommendations. So they are full service, looking at different securities and providing recommendations, whereas discount brokers simply buy and sell on your behalf. So they are buying and selling based on what you tell them to do. Some features of brokers, they execute orders, they hold securities for safekeeping, they extend margin loans, they facilitate short sales, and they provide information and advice about investment alternatives. So these are explicit costs, your brokerage commissions, your brokerage fees. Implicit costs deal with your dealer's bid-ask spreads. So this is compensation to cover the market maker's inventory risk and operating costs. And then we also have what is called price impact. So price impact is the price concession an investor may be forced to make for trading in quantities greater than those associated with the posted bid or ask price. So once again, I kind of mentioned this briefly earlier on. Your entire purchase may not be able to be made at the best bid price or ask price, depending on if you're buying or selling. So once again, let's say the ask price is $1.67 times 100 shares. Let's say you want to purchase 200, so you're not going to be able to fulfill your entire $200 order or 200 share order at the best $1.67 ask price. You may have to spend $1.69 to finish off the next 100 shares that you're looking to purchase. So as I mentioned, now would be another time where if you need a little break before we move on to the next area of Chapter 3, now would be a good time to take that break. All right, last up here in Chapter 3 is focusing on some other types of trading and regulators. So some other types of trading, the first that we will be focusing on is buying on margin. So what does this actually mean? So investors have easy access to a source of debt financing called brokers call loans. Buying on margin means that the investor borrows part of the purchase price of the stock, and the margin in the account is the portion of the purchase price contributed by the investor. The remainder is borrowed from the broker. So the margin is your equity amount. So to calculate, margin is the portion of the security's value owned by the investor. To calculate it, it would simply be the equity amount, so the amount that you have contributed, divided by the total security's value. And this equity portion here is simply the securities value minus the amount of the debt that you have taken on, so your liabilities. So for example, you buy $10,000 worth of stocks with $4,000 of margin loan. Your margin is 60%, 6,000 divided by 10,000. So if I look back up at this equation here, it would be equity, which is security value, 10,000, minus the liabilities, which is your loan of 4,000, divided by the total security value, or the total value of the securities. And so I would get 6,000 over 10,000, which gives me that margin of 60%. Now, what would happen if the value of the stocks drops to 8,000? So now the security value is 8,000. You still owe 4,000 divided by the 8,000 value of the security. Now your margin is dropped down to 50%. So we get that 0.5 or 50% margin with the decrease here in the security value. So what we're going to do, well, before we get on, just a few more things with buying on margin. So the Board of Governors of the Federal Reserve System limits the use of margin loans. The current initial margin requirement is 50%. So you cannot borrow more than 50% of the security value initially. Oftentimes, or what does happen is that there is a maintenance margin, which is the minimum equity that must be kept in the margin account. And then a margin call is made if the value of the securities falls below that maintenance margin, or that maintenance level that is set. So to meet this maintenance margin, sometimes a margin call is made, and you will need to post additional collateral, whether it be cash or securities, to your account. If you do not, then the brokers may sell the securities to restore the margin to an acceptable level. So let's do an example here. Suppose you purchase 1,000 shares of IBM at $200 per share with a margin loan of $80,000. Your broker requires a maintenance margin of 40%. What is your initial margin? So once again, your equation is security value minus liabilities. This tells you how much equity you have, so your value within the securities, your equity value in this deposit, divided by the security value equals your margin. So what we have here is 1,000 shares times $200 per share minus the $80,000 loan divided by 1,000 times, sorry, I might have a little error there. It should be 200, not 2,000, $200 per share. So 1,000 shares at $200 a share. And so what we end up getting is 200,000 is the total value of the securities minus the 80,000 in loan, the margin loan. So my equity would be 120,000, and I divide that by the 200,000 security value, and my initial margin is 60%. So notice that I do exceed the maintenance margin of 40%, and I have an initial margin here of 60%. Let's take a look at another example. How much more could I have borrowed if the maintenance margin is 40%? So what we have here is the value is 200,000. How much more could I have borrowed of this 200,000 to maintain that 40% margin? So if I solve for x here, multiply both sides by 20,000, and then subtract, or by 200,000, subtract 200,000 from both sides and divide by a -1. I could have borrowed 120,000 and maintain that 40% maintenance margin. So I didn't go through each individual calculation, but you would just multiply both sides by 200,000, and then you would subtract 200,000 from both sides and then divide by a -1 to get that the loan amount, I could have borrowed 120,000 to maintain that maintenance margin of 40%. Next up, if IBM drops to $120 per share, would you get a margin call? So let's see what would happen. Would I drop below the 40% maintenance margin? So once again, it's going to be the number of shares times price minus the amount of my loan divided by the total value of the securities. So the $1,000 times price is the total value of the securities minus the loan gives me my equity amount, and I divide it by the total value of the securities to get my margin. So what I have here now is 1,000 shares at $120 per share minus my 80,000 loan divided by 1,000 times 120, and I end up getting a value of 0.333. Would I get a margin call? My margin is decreased down to 33.3%. The maintenance margin is 40%. Yes, I would receive a margin call to add funds to my account to get back up to that maintenance margin of 40%. Now, continuing on, how far can the price drop before I get a margin call? So in the previous problem, it dropped down to $125 or $120, and I received a margin call. How far could it drop without me actually receiving a margin call? So what we're doing here now is we're solving for the P part. So it's 1,000 shares times what price minus the $80,000 loan divided by the $1,000 times the price equals 0.4. So I multiply both sides by 1,000 P, so I get 1,000 times the price minus 80,000 equals 400 P, and I end up subtracting 1,000 P from both sides. I get negative 80,000 equals negative 600 P. Divide both sides by a negative 600. The price could drop all the way down to 133.33, and then anything lower than that would receive a margin call. So that's how margins work. You are borrowing part of your purchase price, and you have to maintain a specific margin amount or a margin percentage with the broker in order to not have to add additional funds or securities. Now let's look at what type of impact this margin purchase can have on different types of returns. So let's take a look at an example where we are going to purchase $20,000 worth of stock with a margin loan of $10,000 and an interest rate of 9%, and we want to compute the investor return after 1 year. So let's first of all say that the price rises by 30%. So in this scenario, I have invested $20,000 total in this stock that has now increased by 30%. So I multiply it by 1.3 to get my total return on the investment. I pay back the $10,000 loan or the $10,000 margin loan at a rate of 9%, so $10,000 times 1.09 to get my total amount of the payment of the loan. So multiply this by 1.09, and then I divide it by my initial investment, the amount that I put in of $10,000, and then subtract 1 to get it into a percent, and I get a return of 51%. So if without the margin, I would have only earned a return of 30% on my investment, but by having that additional $10,000 and the difference between the 30% return and the 9% interest adds an extra 21% to my return. So if I just used my funds as opposed to a margin purchase, I would have had a 30% return, but by doubling my investment in this good time, I've actually increased my return an additional 21% to a total of 51%. Now what happens then if the price is flat? So we do the same calculation, except it's going to be 20,000 times 1, it stays the same, minus 10,000 times 1.09 divided by the $10,000 initial investment. I subtract 1 from it all to get my final percentage, and I end up seeing that I get a percentage of negative 9%. So the cost of the margin would be my loss, even though the underlying stock price actually stayed the same. And there was no increase or decrease. My cost of this is the use of the margin and the interest that I owe on that particular loan. Now, what happens then if the price drops by 30%? So now the $20,000 total investment is only worth 70% of the total amount, and I still owe that $10,000 times a 9% interest fee. I still divide that by the $10,000 that I have committed, subtract 1 to get it into a percent form, and I end up getting a negative 69% return. So yes, it decreased by 30, but when you add in the interest that I owe on the margin that I borrowed, I actually owe an extra 69% total on this particular security. So wrapping this up, buying on margin can be very risky, right? So the intuition is that that you have to remember that you are levered up. You're using debt to fund some purchase, and so you're levered up, especially with these low margins, to both magnify gains and magnify losses. So the buying on margin magnifies this volatility. As you notice in the last example, when the stock price went up 30, the use of margin actually increased my return by 21%, but it also magnified my loss, where it was a 30% decrease in the stock, but in addition, with the margin that I owed, I actually lost 69% on my investment. So you can see that magnifies both gains and losses. The margin requirement protects brokers by limiting the leverage, but it can hurt you badly during bad times, as showcased by that last example there in the previous slide. And when security prices fluctuate, you may be forced to liquidate your holdings and miss out on the recovery. In addition to margins, we also have short sales. With a short sale, it allows the investor to profit from a decline in the securities price. So you're expecting the price of the underlying security to go down, and this is how it works. The investor will borrow a stock from the broker and then sell it. So you're selling a borrowed stock, and then you must repurchase the share of stock in order to replace the one that was borrowed. This whole process is called covering your short position. So with this short seller, you need to pay a lending fee, and then you also pay any dividends or interest that is distributed during this short sale. You also will need to post collateral, either cash or securities, to cover your losses in the event that instead of the stock price actually going down, the stock price goes up. So there are some underlying features of these short sales. One of them being that you pay the broker any dividends or interest that you would receive for the period in which you're borrowing that share, and you also need to post collateral. Now, the proceeds from a short sale must be kept on account with the broker per exchange rules. So let's just look at the difference between a typical purchase of a stock and a short sale. In the typical purchase of a stock, you can see that in time zero, you would buy the share. At the end of the time period, you receive your dividend and you sell the share. And so your cash flow would be a cash outflow, the initial price that you pay. You receive the ending price plus the dividend amount. So your profit would be the difference between ending price plus the dividend minus the initial price that you paid. With a short sale, in time period zero, you actually borrow a share and then sell it, which will be a cash inflow, and then you hope that that stock price goes down, and if you receive a dividend, you repay the dividend, and then you buy back the share. So you have an ending price plus the dividend would be being paid to the broker that you borrowed the share from. So your profit would be whatever the initial price is, so what you sold it at, minus the hopefully lower ending price, and then hopefully not a dividend that would exceed that. So you can see that it's backwards in returns of the buying and the selling of the securities. You're selling it, a cash inflow, and then you buy it back at the lower price, and that's how you would make your profit if what you sold it at is greater than what you bought it back at that later time period. Now, who regulates these security markets? Just some quick recap here. We have some major governing legislation, being the Securities Act of 1933, which required full disclosure of relevant information relating to the issue of securities. And then in 1934 is when the SEC was established. You also have the Securities Investor Protection Act of 1970, which is simply, it's very similar to the FDIC and banks, but this Securities Investor Protection Act protects investors in the event of brokerage firms failing. And then we also have blue sky laws. So blue sky laws are simply your state laws. Self-regulation includes the Financial Industry Regulatory Authority, or FINRA. I'm sure you're familiar with their website. They examine securities, they write and enforce rules, ensuring trading practices, provide information on different securities, etc. And then you also have self-regulation in regards to the CFA Institute, which has their own standards of professional conduct within the industry. We also have the Sarbanes-Oxley Act, which we've discussed previously. From 2000 to 2002, scandals centered on three broad practices, which included the allocations of shares in IPOs, tainted securities research and recommendations, and also misleading financial statements and accounting practices. We've already discussed that in Chapter 1. Some key provisions that came about from the Sarbanes-Oxley Act include the Public Company Accounting Oversight Board, also independent financial experts to serve on audit committees, CEOs and CFOs CFOs personally certify the reports. Auditors may no longer provide additional services, and the boards must have independent directors. And then last up, even with all of these regulations, there are still things called there's still this thing called insider trading. So regulations prohibit trading on inside information. The SEC requires officers, directors, and major stockholders to report all transactions in their firm's stock. And even though this is prohibited, we have seen that insiders do exploit their knowledge. There have been well-publicized convictions of principals and insider trading schemes. I'm sure you've heard the Martha Stewart situation. There's also considerable evidence of leakage, where you have documented abnormal returns on trades by insiders. So this is something where, even though there may not be an actual case in the event of inside information, there is sometimes situations where you can see stock prices fluctuate a day or two before information becomes public, which is just showcasing that there's some type of leakage going on. So that concludes our Chapter 3 discussion on how securities are traded. Once again, we've gone through a lot of information. Hopefully the breaks helped make it a little bit more manageable. But as always, don't hesitate to reach out if you have any questions, and I'll speak to you all soon. Thank you. Bye.